everyone, Markets and Mayhem here, and I want to talk a little bit about the turbulent 20s, what's happened, and where we're going. But first, this presentation is brought to you by TraderAid, helping investors and traders learn more about macro, fundamentals, and technicals, and how that may impact their trades and investments. Learn more at TraderAid.com. First up, where did we come from? Just over the last year, we saw inflation surge. This prompted a rather aggressive intervention by central banks, and justifiably so, as the mantra transitory didn't hold water. Inflation ended up being much more durable. And unfortunately, even though we're seeing some signs of inflation slowing in goods, core services are not giving us that same signal of progress. And while wage growth is slowing, it's not to the point that the Fed can say mission accomplished. And so we are still in an environment where inflation is the primary concern of the Fed and other central banks around the world. Now, this path of inflation has led to one of the most profound hiking cycles in American history. From the bottom of the Fed funds rate range, which was 0 to 0.25%, to where we are now, just above 4%. This all being achieved in less than a year. And it's rather incredible if you think about it, because a lot of the talk at the beginning of this hiking cycle was that the system could not survive anything resembling this type of hiking, or, quite frankly, any other tightening like quantitative tightening. However, the market's been rather resilient, and I think part of it has to do with the idea that everyone believes the Fed will come to the rescue sooner than later. Whether that proves to be true or not is a different question altogether. But for now, market participants are content to fight the Fed, having done so through 3 bear market rallies and been wrong each time. Will this time be different? Time will tell. But in my mind, I think we still have more pain ahead of us, and I think it's particularly important to look at this from a perspective of liquidity, because liquidity has been one of the leading drivers of upward price revisions in various assets, whether it's bonds, stocks, real estate, or even speculative stuff like crypto. And what we can see is that the response to the COVID crash was the most parabolic increase in liquidity in such a short time. The velocity of central bank liquidity entering the financial system was profound, even greater than during the Great Financial Crisis. And equally impressive and concerning is the rate at which that liquidity is leaving the financial system. And we can see it's no coincidence that a lot of the bubbly stocks peaked when the velocity of central bank liquidity peaked. And now we're seeing all of that euphoria, that froth, drain out of the market, really over the last year and 3 months, but particularly over 2022. Not many parts of the market were left with their appreciation from the COVID crash intact, with some notable exceptions, particularly cyclicals, energy, and some more defensive components. But tech got walloped, with the NASDAQ being down, 34%, and ARK, I believe it was down about 70%. A lot of this stuff just doesn't have a place in the portfolio if we are full cycle investors and we're paying attention to the fact that we're at the end of our cycle. And that credit cycle's end portends to people wanting to have more exposure to parts of the market that are more resilient, that have stronger cash flow, better balance sheets, and that means long duration risk gets tossed out. And I don't believe that that area of the market's going to get much of a bid until central banks meaningfully pivot. In my mind, I've been pretty consistent about this. A pivot means significant easing, cutting rates, and going back to expanding balance sheets, or what's called quantitative easing. Now, the UK House of Lords did a study, and they indicated that no central bank anywhere in the world, having done QE, has fully normalized policy afterwards. Will this time be different? I don't know. I don't have a crystal ball, but what I can tell you is I think before they're able to reach their full goals of normalization, that something is going to break, that is going to cause them to want to turn about. And so I believe they will make progress in the fight against inflation. They will likely induce a rather unforgiving recession. But I don't believe that the Fed pivot will come from a victory lap around inflation. I think it will come from the significance of constraints in liquidity within the global financial system and how that may impact financial markets, particularly the banking system, leading the Fed to have to turn about. We have seen some more borrowing at the Fed's discount window, probably related to the amount of bank losses. There's about $750 billion of unrealized bank losses on U.S. bank balance sheets. And that could compel banks to want to take that as collateral, go to the discount window and say, hey, could we borrow a little bit because we don't want to sell this stuff right now? Otherwise, we're going to be in deep trouble. Now, one thing that I've been looking for to say we're approaching a bottom is significant deleveraging. I really want to see the margin debt on a year-over-year basis go down 50% or more, as we've seen during other bottoms, particularly the great financial crisis. And we are not quite there yet. Now, obviously, this data is from November. We haven't gotten the FINRA data for December yet, but I imagine it's going to be somewhat flat. I don't think we saw a lot of deleveraging in the last month of 2022. Certainly price action doesn't suggest that was the case. And until there's excess leverage in financial assets with the rates going up, making it more expensive to carry that leverage, I think the path of least resistance for margin debt is lower. And this margin debt, if you look at this chart compared to the last chart, it tends to track. That is to say, when central banks are deleveraging, when they're reducing their balance sheets, so too do market participants. And with central banks not being done with their quantitative tightening by any reasonable measure, it seems that there's more deleveraging to do within market participants' balance sheets, within their books as well. Now, another sign that the Fed has more work to do is that financial conditions are simply not tight enough, something that the Fed has spoken to repeatedly, both in minutes and during press conferences. And it suggests to us, because Fed speak for financial conditions is really the price of stocks and bonds, that there's more room to the downside. This Fed really wants to reduce some of these artificial wealth effects that have built up bubbles and caused early retirement and tightened the labor force. Unfortunately, with less people in the labor force, it's much harder to bring the rate of wage appreciation down such that we can start to see inflation come down. And whether or not it's the Fed's main goal, they do need to see a more difficult labor market, as Powell has said, and he's also spoken to pain being necessary and that their policies just might not be popular. I can't imagine why. People losing their jobs, their house prices going down, their stock prices going down. I mean, it's not a great situation, but let's look at the bigger picture. For the last better part of 14 years, we were in emergency level monetary stimulus with episodic fiscal stimulus, pumping up asset prices across the board and creating probably the most prolific multi-asset bubble in human history. So the Fed sees this and they say, you know what? We can't create more people. We don't have control of immigration. So all we can do is try to destroy demand for labor, and we can increase the labor force participation rate by taking folks out of early retirement and I hate to say this because I don't want to see anyone suffer, but by eroding their retirement. And so here we are in that situation where unfortunately the Fed has become the enemy of investors in the short term. But if you're a long-term investor and you still have cash on the sidelines, the Fed's your friend because they're draining the excess. The froth is being reduced, and it's likely that better prices are to come as financial conditions tighten. So when the Fed talks about financial conditions, just take a little note. What they're really talking about is that they want bond and stock prices to go down. That's not the entire picture, but that's what is noteworthy for us as traders and as investors. And we can see that there's a pretty strong positive correlation between the size of central bank balance sheets by the Big Five and the mega caps. As the Fed was increasing their balance sheet, particularly post-COVID, mega caps tracked quite well. And now as they're reducing their balance sheet, mega caps are falling, which brings us to an interesting quandary. Is this a big problem for passive investing? The Nasdaq's 40% weighted towards these mega caps. The S&P was at its peak 25% weighted, but now just about 20%. And so that means that 40 cents of every dollar that goes in or out of the Nasdaq is really just going into a handful of companies or out of the same. Similarly, about 20 cents of every dollar going in and out of the S&P, going in or out of those same 5 companies, which means that when they underperform, they actually drag the entire market down. And that's a bit of an issue, but there are ways to trade and invest this. One of the things I said in January of 2022 was maybe it's time to go equal weight instead of market cap weight. And the equal weighted S&P 500 is outperforming the market cap weighted index by the most since 2019, which is pretty incredible if you think about it. That's showing that the once leadership, really since 2012, these very large and growing companies have rolled over. They're not performing. And yet, that doesn't show us the complete picture. So let's zoom in, shall we? The equal weighted S&P 500 is crushing the mega caps. When we just look at equal weight SPX or SPX EW versus the New York FANG index of these mega cap monsters, we can see that if you were longing equal weight and shorting those mega caps, you would have made over 80% in just about 2 years. How incredible is that? Who saw that coming that long ago in 2021 to say, you know what? I'm just going to short the heck out of these leaders and I'm going to go long equal weight. I'm sure some people put on that trade. I didn't see it as 100% clear until the beginning of 2022. And there was still opportunity there. As you can see on the chart, you still would have been able to make, about 35-40%. So there's still opportunity there. But what does this mean? Well, for passive investment, it's not a good sign when a handful of companies, like 5 companies in the S&P, can make up 20% of the index, an index of 500 companies. So let's talk about what is equal weighted. For those that don't know, that means that every single company in the S&P has an equal weighting. So if you were to put $500 in the S&P in an equal weighted index, like an ETF or a fund, you would be putting $1 into every one of those companies. That's a diversified portfolio right there. But if you're using market cap, which is how SPY and SPX and basically is the default for how these indexes are built, guess what? You're putting 20 cents of every dollar into 5 companies. And that's not a diversified portfolio, and it's concentrated in tech. Now, I know they've tried to recategorize them. Oh, Google's communications, and Facebook is communications, and Amazon is a consumer cyclical or discretion. I mean, let's just put all that away. They're all tech. They might have exposure to these other industries. They participate in them, but they're all tech. And so when 20% of the S&P and 40% of the NASDAQ is just in 5 companies, that means that this idea of passive investment, just buy and hold, becomes problematic. You're going to have underperformance of the broader market. And we can see that in these charts, particularly this chart, where it made a whole lot of sense to be diversified rather than to be concentrated. Now let's talk about some of the silliness that happened in 2021 and the analog of the dot-com crisis. Now, I railed against analogs in my last video because I don't believe they're predictive, and this chart wasn't very predictive either. But here's where the value is. This isn't about prediction. It's about comparison. And what it's showing us is that euphoria during the dot-com bubble and bust was similar. People were buying things because they had .com in their name. And I remember it well. I mean, literally, you turn on the TV and companies would just add .com to their name and their stock would appreciate. Or companies that had no business plan that just emerged out of nowhere would list an IPO and they'd be like, hey, I'm pets.com or whatever.com. And immediately the company would double, triple, quintuple. Didn't matter. Didn't matter that they had no business plan, no path to profitability. It was all bubble vision. In fact, you could talk to random people on the street, had no connection with financial markets whatsoever in their profession or otherwise, and they'd be talking about the stock market and these .com companies. Now, fast forward to 2020 and 2021. Tell me how it's different. I know a lot of the folks that got mega long bubble companies during 2020, 2021 thought it was a whole new paradigm, that we were going through some sort of transformative period. Now, don't get me wrong. The fourth industrial revolution is real. The idea of digital transformation is real. But the pricing, the valuations we saw, those were completely just pie in the sky nonsense. There's no way that those companies could grow into those valuations, particularly with the idea that central banks were going to begin to pull liquidity in. They were going to raise the risk-free rate of return by increasing the cost of capital. That put a lot of pressure on these same companies. We can see how well they performed from 2022 on. A complete catastrophe that mirrors some of the bust we saw during the dot-com bust, which similarly were companies that were priced to levels that honestly, don't make any sense whatsoever. When you look at this stuff, you've got to ask yourself, what's going on? And so that's one of the reasons that I think that this was so painful for folks that got very concentrated in these same bubbly names. Because whether we like it or not, fundamentals do matter, macro does matter, and quite frankly, so do technicals. And a lot of these things were showing buyer exhaustion. The other problem was a lot of the gains that we saw in 2021, whether it was Upstart, Tesla, Asana, Affirm, Cloudflare, they were driven by these episodic delta squeezes where people were buying tons of near to the money, close dated options, boosting prices significantly. But when that buying runs out, so too does the rally, and what's left underneath is a pocket of hot air. And we can see it now with what's happening in Tesla, but even back in late 2021 and early 2022, these bubble stocks showed that same unraveling. Something that I was warning about quite a lot during 2021. It was not popular. I got a lot of hate for it. But I asked myself, and I asked others, what is the AI behind Upstart that allows it to have, 400% appreciation or something equally absurd? And yet it was just sort of a very, in my mind, as someone that looks at this through an eye of having a background in technology, it wasn't very a complicated platform. If you ever went through the application process to get a loan with them, you would see that it was actually discernibly worse than a lot of the other lenders, even things like LendingTree that were supposedly based on older technology. So that doesn't mean that there won't be fintechs that actually do revolutionize finance through something that might resemble AI. I just don't think that Upstart was that. I think the price action and the earnings and the debacle of them taking on debt when they said they'd never do that, and now they are really loading their balance sheet with way too much debt, that's a dangerous situation. Particularly as consumers are seeing that they're not able to pay down some of these debts, particularly with revolving debt that has interest rates that are rising, compounding the problems they're facing with a rising cost of everything else in their lives. So when you see an environment where we're going later cycle, and when the cost of capital is appreciating, liquidity is draining from the financial system, risk appetites diminish significantly. And all of the aforementioned stocks here are very high risk. So that's one reason that they fell, and it's a reason that they could potentially continue to fall from here until we turn the corner on rates and on liquidity. Speaking of liquidity, here's the E-mini S&P 500 futures contract. We can go back, this chart goes back to January of 2021. And you can see throughout 2021, this was a very liquid market. These were ideal trading conditions because it didn't cost much to trade except for these, episodic periods of constrained liquidity. Enter 2022. And you can see liquidity dropped off a cliff. That's not good. And you could see those cost to trade, those little red and green bubbles. They had some very, very high peaks, which meant liquidity was very constrained. Now, that leads to more volatility and price discovery, particularly because we have a market that is more and more driven by options. In fact, with S&P options, almost half, 44%, are being traded with 24 hours or less to expiration. And it's amazing because you got to really look at this as the tail wagging the dog. There's over $1 trillion of options premium traded in these and other index options every single day. So when you think of almost half of it being 0 DTE or 24 hours or less to expiration, that's mind-blowing. That tells you we're now in sort of a punter's market, right? That is to say, very short term, people don't have a lot of conviction on direction, and so they're just gambling. And this is at an institutional level. We can't say it's just retail anymore doing this zero DTE lotto stuff. The lottos and Lambo mantra seems to be taken up by large institutions as well. And their trading is going well for them. So, kudos to them. But this creates whipsaw effects in the market. And those whipsaw effects can be rather profound. It can induce a lot of volatility. And so I think for us as traders and investors, we need to consider that some of the biggest movements we've had, like last Friday after the ISM services data came in much worse than expected, the biggest month-over-month contraction since the COVID crash, and we had that near 2.5% rally. That was driven almost entirely by these types of options trades, which is not healthy. Similar to the delta squeezes in individual stocks that I just talked about, this does leave the S&P 500 somewhat vulnerable if there's not real continuation and accumulation. So the last slide I'm going to leave you with is the SPX 4000 level, enormous wall of calls. The biggest one that we can see in spot gamma exposure here. And we're right there, bumping against that potential ceiling. Why does that matter? Because if it does act as resistance, the rejection could be pretty meaningful. On the other hand, if we're able to break above it on a closing basis, that could create some upward pressure. So we are at the inflection point. I lean more towards maybe a false breakout and then the new leg down to new lows, but we'll just have to see what the markets tell us. So I want to thank everyone for tuning in. Really appreciate it. If you enjoy my content, please like and subscribe to this YouTube. Also, check out the content that myself and my team share at TraderAid.com and have 20% off on me. Use the code MAYHEM20, that's MAYHEM20, to get 20% off your first month or year with TraderAid. Thanks again for tuning in, everyone. I'll catch you next time.